Your current mortgage rate, or the interest on your car loan, did not originate at your local bank branch. It was determined by a $145 trillion financial machine that most Americans completely ignore. The United States government is the largest single borrower inside that machine. The national debt is so large that the government now spends roughly $1.05 trillion every year just to pay the interest. That works out to over $2.8 billion a day, which is actually more than the country spends on national defense. To borrow all that cash, the government issues a bond. A bond is a simple contract. You lend the government a fixed amount of money, and in return, they promise to pay you a set percentage of interest every year, and then give your original money back on a specific maturity date. There is one strict mathematical rule governing this entire market. This diagram plots the relationship. When new interest rates go up, the price of existing bonds must go down. They move in opposite directions every single time. Look at the math. If you hold a $1,000 bond that pays 3%, you collect $30 a year. If the government suddenly issues new bonds paying 5%, nobody will buy your old 3% bond for $1,000. To sell it, you have to drop the price to about $600 so that your $30 payout matches the new, higher 5% yield. Every significant financial crisis, an increase in your personal cost of borrowing, follows this exact math applied to a market valued at $145 trillion. In the global financial system, the 10-year U.S. Treasury serves as the baseline for nearly all other debt. The yield the government pays on this specific note effectively sets the price for your own borrowing. When you apply for a 30-year fixed mortgage, the bank looks at the 10-year Treasury, currently around 4.5%, and asks why they should lend to a regular person when they can lend to the government risk-free. Their answer is to add roughly 2 percentage points to cover the risk that you might lose your job or default. If you take out a standard $400,000 mortgage at today's resulting rate of about 6.5%, your monthly payment for principal and interest lands near $2,534. This chart breaks down the math. Watch what happens when the 10-year Treasury yield climbs by exactly 1 percentage point. Your mortgage rate pushes up to 7.5%, adding $269 a month. Over a 30-year loan, that single-point jump in the bond market costs you an extra $96,769 in total interest. You are buying the exact same house with the exact same loan amount, but the bond market has extracted nearly $100,000 from your future wealth without ever sending you an invoice. For half a century, the standard advice for building a retirement portfolio was the 60-40 split, 60% in stocks to grow your money, and 40% in bonds to act as a fail-safe. If stocks crashed, the bonds were supposed to hold their value and act as a financial seatbelt. In 2022, the Federal Reserve raised interest rates faster than at any point in the last 40 years. Because rising rates crush existing bond prices, the supposedly safe bond market collapsed at the exact same time the stock market did, erasing roughly 16% of a standard conservative portfolio. The severity of the damage in your specific retirement account came down to a single metric called duration. Duration is a number printed on every bond fund's fact sheet, and it tells you roughly how much money that fund will lose for every 1 percentage point rise in interest rates. This chart illustrates the brutal math of duration. On the left, a retiree with $500,000 in a typical index fund with a duration of 6 loses $30,000 when rates go up 1 point. On the right, if they held long-dated treasuries with a duration of 17, that exact same rate hike vaporizes $85,000. People bought those funds because they were labeled bonds and assumed they were safe. Ignoring the duration turns a protective asset into a severe vulnerability when interest rates climb. Normally, if you lock your money up in a 30-year bond, you demand a higher interest rate than if you lent it for just 3 months. Economists map these rates on a chart called a yield curve, and under healthy conditions, it naturally slopes upward as the time frame gets longer. Occasionally, short-term borrowing rates spike above long-term rates, creating an inverted yield curve. This happens when the bond market is heavily betting that the economy is about to slow down, forcing the Federal Reserve to cut rates in the near future. This timeline maps the inverted yield curve against the dates of economic downturns. every single one of the last 10 United States recessions, going back to 1955, was directly preceded by an inverted yield curve. It is a perfect 10 for 10 record over 70 years. By pricing in the expectation of future rate cuts, the bond market acts as an early warning system, often predicting a downturn before it shows up in traditional employment or GDP data. That predictive power also controls the stock market. Investors require an equity risk premium, extra expected return to justify taking on the risk of buying stocks instead of holding safe government bonds. When government bond yields rise, that premium shrinks, and investors pull their capital out of stocks, dragging the market down. You can use these exact same mechanics to your advantage. Right now, the national average savings account at a typical bank pays an abysmal 0.38%. Meanwhile, 3-month U.S. Treasury bills, backed by the government, are yielding around 3.7%. If you leave $50,000 sitting in that standard bank account, it earns $190 a year. Moving it to short-term T-bills yields over $1,800 a year. Over 5 years, ignoring the bond market costs you over $8,300 in guaranteed interest, without taking on any additional risk. If you are specifically worried about the cost of living, you can purchase Series I savings bonds directly from the Treasury. These bonds pay a composite rate that automatically adjusts with inflation, providing a direct mechanism to protect your purchasing power. The bond market prices your mortgage, values your retirement, and forecasts your job stability. Once you understand its math, you stop being a passive target for hidden costs and start actively positioning your cash to capture the yield.